Subclass 2.6 Motor Policy Part 2 Fair Value. So both parties to the insurance contract usually stand to gain or lose something based on the insured value of the vehicle. So it can be difficult to objectively determine the fair value. As a result, it is not uncommon for insurers and policyholders to butt heads over what constitutes fair value. TransUnion's Mead and McGrawer's Auto Dealers Digest is a trusted and frequently used source of retail and trade values for most makes and models of vehicles in South Africa. If you ever buy a car, a new one or at a second-hand dealer, you will always see that they bring out this little book. Now that is the Mead and McGrawer's Auto Dealers Digest book they talk about. And if they open it, they will have a look at in that book what is retail on the vehicle, what is trade, depending on the kilometers and all the defaults that they can deduct. And according to that, they will work out a fair value for your vehicle. Motor vehicle policy extensions. So this is where you can add on extensions to your policy. All right, so here we look at the extensions. Cover for the other drivers. So for vehicles that do not belong to the insured and not provided by the insured and is not being driven by the insured in the normal business activities of the insured. For instance, when a representative uses his own vehicle to do a delivery for the insured instead of the insured's own delivery vehicles. Parking extension, accident or damages to vehicles that do not belong to the insured that were being moved with permission of the owner so that the insured could proceed with his business activities. So maybe you want to get out of your premises and then there's a strange vehicle standing there and that person is visiting somebody nearby. Your driver cannot get out of your premises, so you search, you find the person, and they said they're busy, but here's the keys, please move the car. So then you or one of your drivers get into his car and move that vehicle so that your driver can get out. That is the parking extension that they talk about here. Premium adjustments. Cover for vehicles insured on an unspecified basis. For example, all the vehicles are insured under one amount. So the business will have maybe 10 vehicles and insured them all in one under one amount, and there's one monthly premium going to the insurance company. With renewal, the insured needs to supply individual descriptions, total numbers of vehicles, as well as values, so that the premium may be adjusted accordingly. If the insured paid too little during the preceding months, he or she would need to pay the difference in premium over to the insurer. So maybe you had 5 vehicles insured in the last year, but your business expanded, so you bought another 5 vehicles, so now you've got 10 vehicles. You need to inform the insurance about the information, make, models, etc. of the 5 additional vehicles so that they can readjust your premium and have all 10 vehicles insured instead of the only the 5 currently on the policy. Now we look at excesses and exclusions. Okay, motor vehicle policy excess, that is where you need to pay upfront. I'll just put there upfront payment. Upfront payment. Gonna look into that just now. And exclusions. This is where I will not pay. The insurance will not pay out. All right. So the first bullet, typical exclusions, where they will not pay out on personal lines. Motor vehicle policy include losses suffered when using the vehicle to transport fare-paying passengers, because that's for business. If you talk money, if you take money from paying passengers, and you need a PDP license, I think. PDP is also business. They see it then as business because you're making money out of fare paying passengers. Using the vehicle for racing, oh, no, 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 that's a big no-no. Operating the vehicle while you're under the influence of alcohol or drugs. You can add the or drugs there as well. And excess. Now we said in top, excess is an upfront payment. Is the first amount payable by the insured in the event of a loss. It is stipulated in the policy wording and is therefore contractually agreed between the insurer and the insured. They will tell you if they steal your vehicle, you must pay the first 5,000 rand. If you're in an accident, you must pay the first 2,500 rand. To replace your windscreen, you must pay the first 1,500 rand, etc. Okay. So you see it in your policy wording, and if you sign, then it means you agree to that. Insurers have been quite creative in specifying excess based on an age as well as additional excess following theft or hijacking, to name just a few. Excess traditionally served to deter an insured from submitting a claim for minor damage, but is now also used as a tool to reduce the insurer's risk and thereby reduce the premium. So they put that in to say, okay, if you're in an accident, you must pay the 5,000 rand, then they will pay the difference, the balance. Now you bumped your vehicle and there's the damage is 2,000. You must in any case pay the first 5,000 rand before they will pay out. So what happens? You pay the 2,000 out of your pocket, they fix your car, you didn't claim, you save the insurer's money. That's what they want. And because they put in that excesses for small things, it also reduces your premium. It's much cheaper. Okay. One can distinguish between a compulsory excess. So some companies do have a compulsory excess which you cannot change, and normally that will be for your for windscreens, stipulated by the insurer, and a voluntary excess, which an additional excess amount agreed to by the policyholder with the insurer. So some you can agree, they tell them make it lower or take it away. Some is compulsory, you cannot do anything about that. They stay there. What does vehicle refer to? So what is a vehicle? A vehicle at most insurance companies, people, not all of them, every company might have their own definition, but at most insurance companies refer to the following types. Motor vehicles, including a minibus designed to carry up to 12 persons, and station wagons. Okay. LDVs is light delivery vehicles, in other words, bakkies, 4x2 bakkies, 4x4s. Motorcycles, for instance, superbikes, cruisers. Cruisers is typically your Harley Davidson and all these other bikes where you sit back with the high handlebars and you just cruise along the highway. Uh, Tourers and scooters, three-wheel and quad bikes, and also golf carts they see as motorcycles. Caravans, but please note that the contents of caravans are not insured as part of the caravan. That would usually be insured under the all risk section. So, in other words, your camera and your laptop and your jewelry and your watches and your clothes, which you take inside the caravan, now you go on holiday. Now you're standing there at the sea, and now you're just going to town quickly to go and buy some bread and milk, and then somebody breaks in the caravan and they steal the laptop and the camera and the jewelry and the clothing. That will not be insured under the caravan. You will not be paid out. That needs to be specified under your house insurance under all risks. All risk means whatever is insured in the house, you can take out, and if it gets stolen, they will still pay out. Okay. Only, however, the permanent fixtures and fittings of the caravan, that is insured in the caravan. In other words, the fridge in the caravan, the microwave in the caravan, the gas stove, the gas bottle for the stove, things like that. That's fitted to the caravan. Some caravans has got toilets and a shower and a basin. That is all part of the caravan. Those fixtures, those things. covered. And then motorized caravans are insured as motor vehicles because that word motorized says it all. It's like a car, a big car where you can sleep in. You can drive that caravan. You start the engine and it goes. It must go also, yeah. So that is why that will be insured as motor vehicles. And then also they've got trailers insured. Misrepresentation and non-disclosure. Misrepresentation. An insurance company requires an insured, the client, to give honest, full details on all relevant questions that are asked. This is referred to as good faith in insurance and one of the requirements of the law of contract. Therefore, if a client lies or withholds information that could have affected the underwriting, it is seen as material to the policy or the claim, and in such cases, the claim could be rejected. It therefore affects the validity of the contract. So please don't lie to them. Tell them the honest truth. You might pay a premium a bit higher than you would have, but at least they will pay out if something happens. Instead of you don't tell them the truth, you pay a lower premium, but when it comes time to pay out, they found the truth and then they don't pay you at all. And then all that cheap premiums you paid, you in any case going to lose. It's gone. You paid for nothing. Non-disclosure refers to when a client does not disclose all of the required information. You hide some information from them. For example, the client is asked about incidents that occurred during the last 3 years. The client says that he or she has not had any accidents on his or her car in the last 3 years. Advisors should probe further as the client might have had accidents on other cars, which he or she is purposely not disclosing. You might have two cars, one for you, one for your wife. You borrowed your wife's vehicle, you were in an accident with the previous insurance company you claimed 6 months ago. But now it's your wife's car, so it's back at the house, the wife is driving. Now you want to get insurance for your vehicle. Now you tell them, I was not in an accident with my vehicle. But the problem is you were in an accident with your wife's vehicle, with the other car. You need to disclose that as well. Or the client only gives one incident and keeps quiet. You might have had 5 accidents in 3 years, but you just said, "Yeah, I just had one that was 6 months ago." You don't tell them about the other four. Remember, the insurance company, they tend to investigate. They're going to go and check on your ID numbers or where that you had insurance, and they will find out from the other insurance companies. You had insurance there, you claimed from them, you didn't disclose it here, and then they might kick you off. They might cancel your insurance policy to tell you that they don't want business to do with you, any business to do with you, because you're not open and honest. Or they can uplift your monthly premiums. They can make it higher. Where will you be covered? Territorial limits. Most insurance will cover the vehicles when used for private use in Swaziland, Lesotho, Mozambique, Botswana, Namibia, Malawi, and Zimbabwe. But you must just get permission from your insurer before you go to that country. Now, every year when we go to Mozambique for holidays, we find our insurance company, we tell them we're going to Mozambique. From that day, we'll enter at the border post, and that day we'll exit at the border post. Then they tell you, okay, in that 10 or 14 days, they will be covered. Sometimes they charge you something ridiculous, like 150 rand extra. Other months, other times, they didn't charge us anything. So it depends. Even when you want to go to Botswana or Lesotho, you must just arrange that with your insurer. Additional benefits to the comprehensive cover. Some of the most common cover extensions are wreckage removal, sometimes with a limit to the amount that can be claimed. So your vehicle is in an accident. Normally, the insurance company, they will send a low bid to come and collect it, but you will have to pay for it. But if you've got the additional benefits to comprehensive cover, they will send the low bid truck and they will pay for the low bed to take you to the nearest panel beater. Locks and keys, cost following loss of damage up to a limit without affecting the no claim bonus discount. Yes, that can also be a costly exercise. I was on holiday in Mozambique one December, and one of our friends, she arrived there with a brand new Land Rover. She was proud. She just got it recently, and in December holiday, she lost that expensive keys of that Land Rover. The spare keys was at her home in Johannesburg. So she couldn't even drive her own car to go and fetch the spare keys. So they had to get somebody from Land Rover in a nearby town in South Africa. I think it was Mbombela, to drive through to Mozambique with a new key, and they had to, it's computerized keys, they had to fix it so that she could start the Land Rover again. That cost a couple of thousands of rands. Luckily, she had lost key insurance, so they paid for it. Otherwise, she had to had to get a lift to Johannesburg to go fetch her keys and go back. And when we are, it's 2 days drive to Johannesburg and 2 days drive back again. Towing charges following electrical or mechanical breakdown, medical expenses cover, trauma counseling, or emergency accommodation. That's all extra additional benefits. So they're not standard inside with the policy. Looking at additional benefits to comprehensive cover. Additional benefits at an additional premium. So you paid your insurance, but it doesn't include the following. So for additional benefits, you must pay an additional premium. So cover of unintentional violation of a policy condition. So the policy condition says you're not allowed to do this or that, and by mistake, you violated that condition. And now they are not going to pay out. But because you took out additional benefits, cover for unintentional violation of that policy conditions, they will pay out. Shortfall cover. So you bought the vehicle, let's say for 100,000 rand, but you finance it at the bank. So the bank puts in interest for the finance, and now you owe the bank, let's say 130,000 rand. But the value of the vehicle is only 100, so that it's insured for 100,000 rand. Now it gets stolen or damaged or written off in an accident, so the insurance company is only going to pay you out that 100,000 rand which it was insured for. So if you take shortfall cover, that will say, okay, we will also pay the interest, the 30,000 rand interest, the shortfall you're going to have at the bank. Otherwise, if they pay you out 100,000, you will still owe the bank 30,000 rand interest. So then they will pay out 130,000 rand so that you can settle the vehicle at the bank. And then you don't have shortfall, a problem. Then you don't have to find the 30,000 rand somewhere. You all understand that. Excess waiver, if you've got that covered, you said, all right, I don't want to pay excesses. So then you add that as an additional benefit. Extended liability, you can add that as well. Contents of caravans. Remember we said that your laptop and cameras and jewelry and clothing and the cameras is not insured under the contents of the caravan. It must be under your house insurance for all risk. But you can also add it as an additional benefit to tell you, listen, the things that I'm going to have in my caravan, I also want that insured. The windscreen repair and also car hire. I've added car hire with mine, so in case my car is in an accident or gets stolen, now I'm sitting without the car and it's a battle to get to work and go and visit people over weekends. I pay, I think, 50 Rand a month extra, and then I can get 30 days free car hire. My insurance company, they bring the car to me, and then I can drive it until my car is ready for collection. I can fetch my car, and then they come and collect the rental car from me again. So that is all additional benefits, but it costs an additional premium. Your trade, your retail, your market, insured, and settlement values. The value is determined as follows: the retail value. So your retail value is the value of the vehicle. So let's say you bought your vehicle is the value is 100,000 rand. Then we look at market value, which will be between. That's the value between retail plus trade. Then divided by 2 gives you that amount. And then the trade value, it will be less than retail. Let's say, for instance, 80,000. Because you trade your vehicle in to buy another one. So the second-hand car dealer, because your car is valued at 100,000 rand, he wants to sell it for 100,000 rand. So the second-hand car dealer is not going to give you 100,000. He might give you 80,000. So that he can spend maybe another 5,000 to fix the small things, and that he can sell it for 100,000 and make a profit. You see, when you look at market value, it's a price between the retail. So it's retail, we said the retail value is let's say, I'm doing a new calculation here. Let's say it's 100,000 rand, that's your retail value. I'll just put in brackets retail that you can understand. Plus the trade value, and here we said the trade value is 80,000 rand. All right, you see the 80,000. So then we plus the 80,000 rand. That is my trade value. Oh, sorry for that. That gives me an amount of 180,000. But we said we must divide it by 2. Divide it by 2. So divide it by 2, and that will give us an amount of 90,000 rand. 180 divided by 2 is 90,000 rand. And this 90,000 rand, that will be my market value. You all with me? All right. And then we can look at the nominated value, agreed value basis. That is normally for your old age cars, your vintage cars that doesn't have a trade market or a retail value. Because yeah, so you agreed to a value. You get take it to the vintage clubs. They get a certified or somebody there which will establish the value of that vintage car, or even if it's an imported vehicle. Get somebody to give you a nominated, agreed value, a nominated value. And then also a settlement amount. Whatever you need to settle settle at the bank. So maybe you bought the car, the things for 100,000 rand, but you need to settle because you paid over the years and you only owe the bank 20,000 rand. Then you said, okay, you only want the settlement amount. So whatever you owe in the bank, they must just settle it. So then you will pay a lower premium. All right. Trade value, it is the value according to the TransUnion Dealer's Guide that you should be paid by a dealer when trading your vehicle in. This value is influenced by condition of the vehicle and the mileage. So the vehicle dealer will look in that book and he'll decide, okay, this model car with so much mileage on, kilometers on, that is the value. And that is what they will be willing to give to you. Retail value, current selling price of a vehicle at a dealer according to the TransUnion Dealer's Guide. The value will include factory fitted accessories. The vehicle's age, condition, and mileage might affect the value of the vehicle at time of loss, and that's the market value. And the market value, as we said before, is the average between the retail and trade value. So it's the retail plus trade divided by 2. That will give you your market value, as I just shown you before, where the vehicle, let's say the retail value is 100,000 plus the trade value is 80,000 divided by 2 gives you 90,000, and that's your market value. So your market value will be between the retail plus the trade divided by 2. Nominated value, in the case of collectors or vintage vehicles, certain insurers are willing to insure a vehicle for more than the retail or trade value because it's worth more. Especially for vintage cars, there's guys that are collecting them, and they're after certain kinds of vehicles. And then they were willing to pay more. My father bought a 1958 Mercedes 220S, as I said before, for 3,000 Rand. And that car was valued at 80,000, but I think at the end of the day, he had the collector that was willing to pay him 100,000 for that old car because he was looking for it, and because it's vintage, you cannot go and buy them around every corner. There's only a certain amount of them, very few. And his car was still in a very good condition. He won vintage shows for the most original Mercedes of 1958 models. They would require a valuation certificate from a reputable dealer. The valuation certificate usually cannot be older than a year, and the new certificate must be supplied every year. Some insurers refer to this as the agreed value. Settlement value, in terms of the insurance contract, the settlement value refers to the total amount, the maximum indemnity that the insurer agrees to pay, from which certain deductions can be made as per the policy wording. In terms of the finance agreement, the settlement value refers to the total amount owing to the financial institution, including earned interest. There is certain deductions, so see the study material. It can be the amount that you owe the bank that needs to be settled. Additional items that should be insured. Any non-standard accessories must be specified separately on the policy, either under the motor vehicle section or at some insurer under the all risk section, and an additional premium is payable. And these include car radios, CD shuttles, and speakers. Some insurance will indemnify for these, but only pay up to a certain limit of 1,000 Rand, and the normal vehicle excess applies, plus the loss of a no-claim bonus. So you also maybe lose your no-claim bonus if you want to claim for a car radio or CD shuttle, etc. Special wheel rims or mags, if they are not specified, it might be paid to a limit amount subject to motor excess, or they might not pay it at all. Additional items that also should be insured is things like your tow bar, a canopy for your bakkie, a sunroof, nudge bar, running boards, leather seats, Bluetooth application, satellite navigation system, and performance enhancements on the vehicle. Now we look at liability cover. Some insurers automatically included liability cover as part of their comprehensive and limited car insurance package, but you can also select this as standalone cover. So yes, it depends from insurer to insurer. Some do include it, and others you must add it as a standalone cover. You'll enjoy up to 5 million Rand in liability cover for the vehicles that's insured by certain insurers. Even if you are driving a French vehicle, you can be held legally liable for causing an accident. You'll still enjoy liability cover. Because he was not driving it, you were driving it, you made an accident, and now somebody's got the claim. There are various sections of short-term insurance, such as house owner's insurance. That's to cover your house, the actual building, not the contents inside. That is, if the house burns down, you need to rebuild that house. So that's the house owner's insurance is to rebuild that building or to fix the building. Household insurance, household insurance. That's the contents of your house, inside the house. Your furniture, your TV, your clothes, your jewelry, all that kind of things. And then we get all risk insurance. That is all the things that you take with you and out of your house. Like your cameras, laptops. I put your laptops. If your laptop is inside the house and gets stolen, they'll pay out. But if you didn't specify it under all risk insurance, they will not pay out. So things like that, your laptop that you take out of your house, jewelry that you wear, you take out of the house, jewelry. I hope I spelled it correctly. Cameras, expensive watches, which is actually part of jewelry, or whatever, you, etc. You take out of the house. Car insurance, you also need liability, personal liability, and personal accident. There are different liability cover policies available on the market for specialized functions such as employer's liability, products liability, defective workmanship, and contractor's liability. And that's the end of part 2 of 2.6. If you've got any questions, you know what to do.